Hello everyone, and welcome to our training course on developing financial models. Our training is hands-on and practice-oriented, focusing on working directly with Excel to build practical skills you can immediately apply to real-world scenarios. Whether you're new to financial modeling or looking to refine your expertise, this course will give you the tools and knowledge to build strong, flexible models. Let's dive right into developing a financial model using example 1. I'd like you all to open example 1, which was included in your documents. This example is essential as it lays the foundation for our course, giving us a practical scenario to work with. In this example, we are planning to build a plant for the production of autoclaved aerated concrete. The example details the capital expenditures for the project, including the design, documentation, development, construction, and installation works, and the purchase of production equipment. Capital expenditures represent the direct investment costs that the company must incur to execute the project. These costs are incurred during the investment period. Every project is divided into two phases: the investment period and the post-investment period. All investment costs are concentrated in the investment period. This includes activities such as construction, installation work, equipment purchases, and more. Once the project enters the post-investment period, the company begins operating the facility, in our case, the plant. The example also outlines the conditions for purchasing production equipment, which is financed through borrowed capital at an interest rate of 6% over a term of 7 years. The plant's capacity is projected to be 200,000 cubic meters per year, with a selling price of $50 per cubic meter. The example also lists the personnel involved in the project. Additionally, we have details on the costs of raw materials per cubic meter, the area required for the plant, and other expenses. These inputs are crucial as they directly affect the financial outcomes we will calculate. Now let's begin calculating this example. I ask you to open the financial model included in your documents. This model is the tool we'll be using to translate project details into actionable financial insights. Open the model and let's briefly familiarize ourselves with its structure. A little further down, you'll notice the sheets are numbered. I'd like to mention that this numbering is arbitrary. You can name the sheets however you like. In our case, they're labeled alphabetically, A, B, C, D, and so on. Let's start with the first sheet, which is the dashboard. On the dashboard, we enter all the initial information necessary for calculating the project. This includes depreciation rates and tax rates. Our model is designed to be universal, meaning you can adapt it to reflect the current taxes and rates relevant to your region when working on your own projects. At the top of the sheet, we see the project's results. These are the key financial indicators. These include net present value, NPV, and internal rate of return, IRR, which are the most critical metrics for evaluating any project. Additionally, we include the payback period. You will learn how to calculate all these metrics in detail later. For now, the dashboard simply displays the project's outcomes to provide an overview. Also, note that on this sheet, we specify all the input parameters for the project, including maximum production capacity, selling price, cost per unit of product, and so on. This setup is essential for maintaining flexibility in your model. All parameters that might change in the future are specified here. For example, in our project, the selling price is $50 per cubic meter. We enter this figure in the dashboard and use it to calculate gross revenue. If the sales price changes later on, we update it here, and the entire model recalculates automatically. This is the core benefit of a well-built financial model. It should be automated to handle changes seamlessly. If we adjust any parameter, the entire model recalculates accordingly. These are the basic requirements for any good financial model. So, we've briefly discussed the first sheet, the dashboard. Let's move on to the next sheet, Sheet A. This sheet details the investment costs. Here, we enter all the capital expenditures for our project. Based on our example, our capital expenditures include design, documentation, development of at $70,000, construction and installation works at $1,100,000, and the purchase of production equipment at $1,500,000. We need to enter these items into our table on Sheet A. But first, let's familiarize ourselves with the capital expenditures table. Understanding the structure of this table is key to entering data accurately. Let's walk through it briefly. In column B, we enter the name of the capital expenditures. Column C shows the amount of capital expenditures. Column D reflects the share of total investment and the sources of financing. This distinction is important because it helps us track how the project is funded and where the money is going. An example will now make it clearer how to fill in the form. Let's go back to the example and enter the first expenditure, which is the design and documentation development costing $70,000. In line 9, we enter the first item, $70,000. Next is construction and installation works, costing $1,100,000. Enter this on the next line. Finally, enter the purchase of equipment, which costs $1,500,000. This methodical approach ensures that every expenditure is accounted for and properly categorized. We have indicated all the capital expenditures mentioned in the example. However, I'm going to ask you to add one more line. This will be a line where we indicate the working capital. Working capital represents the amount the company needs during the initial phase after opening and starting production. As we all know, before the company can produce finished products, it must first purchase raw materials. It will take some time to ramp up to full production capacity. During this period, the company might not generate enough revenue to cover its operating costs fully. This gap can lead to short-term liquidity challenges. Considering these processes, the company may not be able to fully cover its costs in the early stages. Therefore, it will need additional funds to bridge any liquidity gaps and cover the expenses incurred after the launch. It's important to set aside enough working capital to keep the new facility running smoothly until it reaches normal production and sales levels. Let's add an additional row and name it Working Capital. Right-click on the row number and click Insert. Label this new row as Working Capital. We will calculate the exact amount of working capital later when we analyze the cash flow statement. For now, leave this cell blank. This addition will help us accurately figure out the project's total financial needs and make sure we have enough cash to handle the early stages of operation smoothly. In the total row, we need to sum up all our capital expenditures. We have 4 items, so in row 13, we'll enter the total capital expenditures. To do this, we use the following formula: sum. Open the bracket and select the 4 lines of capital expenditures. At this stage, our total capital expenditures amount to $2,670,000. Next, let's break down the proportions of each item. We'll calculate the percentage of total capital expenditures that each item represents. For instance, we'll take the amount for design documentation, which is $70,000, and divide it by the total capital expenditures. The formula is straightforward. Cell C9 divided by cell C13. To ensure the formula works correctly when applied to other rows, we'll need to lock cell C13 so that it doesn't shift when we drag the formula down. To do this, select C13 and press F4. This locks the reference, making it absolute, so it remains constant as you copy the formula down the rows. With cell C13 locked, we can now drag our formula down to row 12. Once done, enter the sum formula again and add up all the rows. In our example, the result is 100%. We can see that 56% of all capital expenditures are allocated to the purchase of production equipment. Now let's move on to specifying the funding sources for each item. From our example, we know that the equipment is purchased with borrowed funds, while the design documents and construction works are financed with equity. Let's return to the model and indicate these sources. In columns E and F, we'll indicate the sources in absolute figures, in dollars, and in columns G and H, we'll enter everything as percentages. We start by entering the sources as percentages. Equity finances the design documentation and construction works, while the equipment is purchased with borrowed funds. So in column H, enter 100 for borrowed funds under the equipment purchase row. Working capital is financed with equity. Now, let's calculate these amounts in absolute terms. The formula is simple. We start by putting an equal sign, selecting the amount for each item, like $70,000, and then multiplying it by the corresponding funding source. For column E, equity, we multiply the investment amount by the equity percentage. Next, we select the capital expenditures again and multiply them by the source in column H, borrowed capital. Drag these formulas down to row 12. The results show that $1,170,000 is financed through equity, while $1,500,000 comes from debt. With the capital expenditures for the project calculated, we can move on to sheet A0 to work on the financing schedule.